Hi everyone! So in previous videos, we looked at the EV market through car makers like BYD, Xiaomi and Geely. Today I want to go one layer deeper into the supplier side. And for that, I want to focus on LiDAR, a technology I find particularly interesting for the next stage of smart vehicles, robotaxis and robotics, with a deep dive on Hesai. Before looking at Hesai, we need to understand the basic problem. When a car starts to assist the driver, or when a robot moves in a physical space, the machine needs a reliable view of its surroundings. It has to estimate distance, movement, obstacles, road shape, and visibility conditions in real time. Car makers and robotics companies use several sensors for that. Cameras are strong for visual recognition. They help the system interpret lanes, signs, traffic lights, and objects. Radar is useful for distance and speed, especially in rain, fog, or poor visibility, even if the image is less detailed. Ultrasonic sensors are mainly used at very short range, especially for parking. LiDAR adds a more precise 3D distance layer around the vehicle or the robot. So the debate around LiDAR is really a debate about sensor architecture. Some companies prefer fewer sensors and more software. Others prefer more redundancy, especially when the system becomes more autonomous. Now, what does Hesai actually sell? Hesai sells LiDAR sensors mainly for three types of use. The first one is automotive ADAS. ADAS means Advanced Driver Assistance System. Features like highway assistance, lane support, automatic emergency braking, obstacle detection, and more advanced smart driving functions. This is the main market today. The second one is autonomous mobility. Robotaxis, autonomous shuttles, robobuses, or delivery vehicles. Here, LiDAR is usually combined with cameras, radar, and software, because the vehicle needs a stronger perception system. The third one is robotics and industrial applications. Warehouse robots, logistic robots, mapping, inspection, cleaning robots, agricultural robots, and potentially humanoid robots later. And on this chart, you can see the split clearly. Automotive ADAS is still the main volume driver, but robotics and autonomous mobility LiDAR shipments are increasing over time. They are still smaller than automotive, but they are becoming a second growth engine for Hesai. So the company is mainly an automotive LiDAR supplier today, with a growing robotics layer behind it. The industry still has no single answer on the best sensor strategy. Tesla is the most famous example of a camera-first approach. The company has built its autonomy strategy around cameras, software, and driving data. The advantages are obvious: lower hardware costs, cleaner vehicle design, fewer components, and a system trained on a very large driving dataset. Many robotaxi companies have gone in another direction. They usually combine cameras, radar, and LiDAR. When there is no human driver actively ready to take over, the system needs a stronger safety margin. LiDAR can help because it gives a precise 3D distance layer, which makes the perception stack more resilient. That doesn't mean LiDAR is the only answer. it means LiDAR becomes more attractive when the autonomy level rises and when the cost becomes acceptable. Regulation follows the same logic. Regulators generally do not force car makers to use LiDAR. They set safety requirements, testing conditions, and approval rules. So the sensor choice remains mostly an engineering and commercial decision. But if safety standards become stricter, and if robotaxis need more redundancy, LiDAR can benefit indirectly. For years, the main problem was price. LiDAR was useful, but too expensive for mass-market cars. It made sense for robotaxis, mapping vehicles, premium models, or advanced prototypes, but it was harder to justify on normal passenger cars. That equation is now changing. Costs have fallen, production is scaling, and Chinese EV makers are moving faster than most foreign brands on smart driving features. In 2022, LiDAR was still almost invisible in the broader passenger car market. By 2025, penetration had reached 11.2% in this full passenger car proxy. Globally, adoption is still much lower. The world penetration chart reaches around 3% in 2025. So China is already ahead, the global market is still early, and for a company like Hesai, that creates both upside and uncertainty. Now, let's look at the competitive landscape. This chart is useful because it shows how young and unstable the market still is. Hesai is one of the strongest players in China, very close to Huawei in the latest data. That is already a strong position because China is the most advanced market for LiDAR adoption in passenger cars. But Huawei is not a small competitor. It has deep relationships with Chinese car makers, a software ecosystem, strong industrial capacity, and a much broader smart vehicle strategy. The RoboSense example is also important. The company had strong traction before, but its market share fell sharply. So Hesai is well positioned, but the market is far from settled. Now we can move to Hesai's own numbers. When we look at revenue, the chart is not spectacular at first glance. Revenue is growing, of course, but it doesn't look like a pure hypergrowth chart. Compared with the shipment curve, it can even feel a bit disappointing. The explanation is here. Revenue per LiDAR has fallen heavily. Hesai is selling many more units, but each unit brings in much less revenue than before. This is probably the most important tension in the investment case. Lower prices are positive for adoption. LiDAR cannot become a mass-market automotive component if each sensor remains too expensive. For shareholders, the equation is tougher. Hesai needs manufacturing costs to fall at least as fast as selling prices. So if the company succeeds, volume growth can turn into operating leverage, but if prices fall faster than costs, the market can grow while profitability remains under pressure. This is where the financial story starts to change. Even with a sharp decline in revenue per unit, Hesai moved from deeply negative EBITDA margins to positive territory in 2025. So the scale-up is starting to appear in the economics. The EPS chart needs to be read in three phases. First, Hesai was still in investment mode. The company was building products, production capacity and customer programs, so losses were normal for this stage. Then, in 2025, operating leverage finally started to appear. Shipments were much higher, cost control improved, and the same industrial base started to absorb more volume. That is why EPS moved into positive territory. The strong Q3 shouldn't be treated as a normal run rate. It was helped by items outside the core operating business. Q4 gives a cleaner view of a new profitability level. Positive, but not spectacular. And Q1 2026 shows that the business is still early, with some seasonality and new initiatives still absorbing investments. So the EPS chart is encouraging, but it doesn't yet show a major earnings profile. It shows a company that has crossed the profitability line and now needs to prove that this profitability can hold while prices fall and new investments continue. On CapEx, the chart is quite straightforward. Hesai still needs to invest because this is an industrial business. If the company wants to sell LiDAR at lower prices, enter more vehicle models, and grow in robotics, it needs production capacity, automation, and manufacturing efficiency. But the important point is CapEx intensity. The heaviest phase seems to be partly behind the company. CapEx is still meaningful in absolute terms, but as a percentage of revenue, it has become more reasonable. So I wouldn't expect CapEx to disappear. For Hesai, CapEx is part of a cost reduction story. The company needs scale to bring down unit costs, and that is exactly what can protect margins while LiDAR prices continue to fall. And now the financial structure is easier to understand. Even though Hesai had several quarters of losses and a heavy investment phase, the balance sheet stayed relatively healthy because the company raised capital at key moments. It raised money before the IPO, then through the Nasdaq IPO, and again with a Hong Kong listing. That gave Hesai the financial room to build production capacity, fund R&D, absorb losses, and still keep a strong cash position. This chart is consistent with what we saw on CapEx. Hesai is now generating positive operating cash flow, but CapEx is still heavy. So free cash flow remains negative across the period. The important point is the direction. Operating cash flow has improved, while CapEx no longer looks as extreme as in the heaviest investment phase. So the free cash flow profile is still not clean, but the trend is better. For me, this is the next financial checkpoint. Hesai has already crossed the profitability line on EPS. Now, the company needs to prove that it can turn that operating improvement into real free cash flow without cutting the investments needed to scale production and reduce unit costs. Now on valuation, the stock is demanding. At the current price, Hesai trades at roughly 7 times sales and about 47 times reported earnings. And even that PE needs some caution because part of the last 12 months' profit came from a non-core gain. If we normalize that out, the PE is closer to 74 times earnings. So on today's numbers, the stocks looks expensive. But this is also a company with a very strong growth profile. In my base case, I would expect something around 20 to 30% annual revenue growth over at least the next 5 years, driven by higher LiDAR penetration in ADAS, the rise of robotaxis, and the growth of robotics and autonomous mobility applications. With that kind of growth, the valuation becomes more understandable. So when I put everything together, I think the attraction of Hesai is quite easy to understand. The company gives exposure to smart EVs without directly buying an automaker. That is valuable because the EV market itself is brutally competitive. BYD, Tesla, Geely, Xiaomi, and others are fighting on price, models, software, distribution, and brand perception. With Hesai, the exposure is different. You are buying a supplier positioned on one specific layer of the smart vehicle value chain, perception. If LiDAR becomes more common in smart EVs, robotaxis, and robotics, and this is already visible in Hesai's shipment numbers over the last 3 to 4 years, helped by the sharp decline in LiDAR prices, Hesai can benefit from that broader adoption. The company already has scale, it has strong traction in China, it has reached profitability, robotics gives an additional long-term option, and the balance sheet gives it room to keep investing. But there are also weaknesses. The first weakness is the price dynamic. For LiDAR to become more common in smart EVs, robotaxis, and robotics, the price probably needs to keep falling. That can support adoption, but it can also put pressure on margins. The positive side is that a large part of the adjustment has already happened. Hesai has already managed to bring the price per unit down sharply while improving profitability, which is quite impressive. So I wouldn't see price reduction as a fatal problem, but it remains a constraint. The company still needs to reduce costs fast enough to protect margins while selling into a more mass market environment. The second weakness is adoption outside China. In China, LiDAR penetration is already visible and car makers are moving fast. Overseas, the situation is different. Penetration is still much lower, partly because of cost, but also because some companies have already made strong technology choices. Tesla is the obvious example. It has invested massively in a camera-first architecture, software, and real-world driving data. For a company like that, adding LiDAR later would mean changing the hardware architecture, the design logic, and part of the perception stack. That is possible, but it is not a small decision. There is also a design issue. LiDAR has to be integrated cleanly into the vehicle, with constraints around aesthetics, aerodynamic, reliability, and costs. That makes adoption more complicated than simply saying the technology is safer. The last risk is geopolitical, especially outside China. LiDAR itself is not banned or forced by regulation. The problem is that Hesai is a Chinese supplier in a sensitive field: autonomous driving, 3D perception, and connected vehicles. In the US, the company has already been caught in the national security debate. So even if Hesai can still sell internationally, some Western customers may hesitate, especially if the product becomes more strategic for higher level autonomy. So overall, I think Hesai has a strong future ahead and can definitely deserve a place in a portfolio, especially if you don't already have exposure to EV-related stocks. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe, and share.